Stocks trade ranged, awaiting a clear signal on the India-US mini trade deal. FMCG and IT eke out gains, while autos and metals drag.
State Bank of India is expected to launch its 25,000 crore QIP today. The offer, CNBC-TV18 learns, is likely to be at a small discount to current market prices and could see strong subscription from insurers led by LIC.
HDFC Bank's board will consider issuing bonus shares and declaration of a special dividend on July 19. This move follows the bank raising 10,000 crore from its divestment of part stake in HDB Financials.
A draft notification of the government of Karnataka looks at cap price at the theatres and multiplexes at Rs 200 per ticket. The move, if implemented, can significantly dent revenues of PVR Inox and impact the profitability. Hello, good afternoon and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Mangalam Malu as well as Ekta Batra as well. Good afternoon to you as well. And seems like just a few minutes ago, we've seen a bit of a spike coming in the market, though it's not anything exciting so far as well. But the mid and small cap, that manages to do well. Mid cap is trading with slight bit of a gain. At least that green is there. Mangalam, the mid cap is wanting to twin with you today.
Yeah, because it's right above my head as well right now. I'm looking at the mid-cap index as well as the Nifty. The important part, however, is that it's a very good trading session from a bull standpoint, given the start that we were expecting. Yeah. Overnight, there was weakness on the Wall Street. Yesterday, we broke away from 4 days of, losses. And now the low being protected and us actually rallying from the lows is good sign from the market's health standpoint and the bulls. More importantly, if you look at the broader markets as well, we have more number of stocks which are advancing than the number of stocks which are declining. And some of the frontline indices or frontline stocks are doing extremely well in today's trading session. Put up something like a Nestle that's moved to the high point of trade, fairly well bid on that stock. And the IT stocks, they continue their up move from yesterday as well. So they've been underperformers. Now the IT stock supporting the frontline index yesterday as well as today does well for the sentiment at large, and actually the up move both yesterday and today has been led by the IT pack.
Yes, absolutely. So overall, you'd have to say that yes, we're incrementally better from where we started, but still a range-bound day of trade. But what we do need to focus on is a lot of earnings in today's trading session as well as over the week. So for today, we have Tech M, L&T Tech Services, ITC Hotels, Angel One, which will be releasing numbers tomorrow. Axis Bank, LTI Mindtree, Wipro, HDFC, AMC. So a lot of these companies will be releasing their numbers. Friday, we have Reliance Industries. And then on Saturday, we have HDFC Bank and ICICI also releasing numbers. So it's definitely going to be a power-packed few days when it comes to Qs, especially from the frontline space. So that's what's taking place in terms of the markets right now. But I'm watching a couple of stocks, guys.
Yes, Biocon, that's what you're watching, Ekta. We want to understand why exactly are you looking at Biocon? What exactly is happening out there? What's the reason?
Well, yes, Biocon is in focus because the US FDA has approved a key diabetes treatment drug, which is insulin aspart, or they branded it as Christy, in the US market. So the US drug regulator has basically approved the biosimilar version of insulin aspart in the US markets for Biocon. Now, it is interchangeable as well. So that means that basically, if you have a prescription, you go to the chemist and or you go to the pharmacy in the US, they will only be able to give you what's on the prescription. But in this case, if the drug is interchangeable, then they can give you Biocon's drug, even though there is another drug's name written on the prescription. So that is basically what it means when you talk about interchangeability. In this case, I assume if it is the patented drug's name which is written on the prescription. Overall, expected to be positive because it's been a long journey. They did have a CRL on this particular drug and then they eventually got approval for it. This Malaysia plant where it's manufactured was inspected just in September of 2024. $1 billion in terms of market size. So let's see what they come down to in terms of opportunity. $100 million is possibly what they could earn, and it could probably even go up to around $300 million based on market dynamics. So overall, net positive for Biocon, up around 1.4% for the stock.
Okay, that's interesting there. And a lot of positive news has been coming around Biocon in the recent times as well, right? The facility clearances as well. So this one surely keeping the stock abuzz in today's trading session. But let's move on. And his first television interview since taking charge as the RBI governor, we had Sanjay Malhotra. And he's saying not allowing foreign banks to own a 26% stake in Indian Bank defies the logic. In an exclusive conversation with Lata Venkatesh, he promised that RBI will examine cases if any requests are made. And the governor was asked about this in the context of Dubai-based Emirates NBD Bank as well, potentially picking up stake in private lender RBL Bank. Here is what he had to say.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission. Right. Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%,
yes.
All right? And the foreign banks can actually start business in our country as even up to 100%. So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have 26% stake, economic interest, voting rights.
Yeah.
There should not be any difficulty in them having up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of clarity is not there, some ambiguity is there, as you are saying.
No,
we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
Right, and that was the RBI governor speaking to Lata Venkatesh in a no-holds-barred conversation, and a lot of insight coming in out there as well. Sudarshan joins in with what he makes of the RBI governor's commentary on RBL Bank. Sudarshan.
So there is an update in RBL Bank. So basically June shareholding pattern is released and there is a big uptick in the holding of mutual funds and FPIs. And in front of that, there is a reduction in the holding of foreign companies as well as retail. So for mutual funds, as of June 2025, total holding has increased to more than 29%, and in the end of March, it was just around 15.3%. Similar pattern was seen for FPIs. As of June, its stake has increased to 17.6% from 14.4%. As far as retail is concerned, the stake is reduced to 28.7% from 38.7%. And for foreign companies, because British International Investment had sold the stake, so foreign companies' stake has reduced to 3.5% from 7.4%. As far as insurance companies are concerned, they continue to hold stake around 3.3% stake. Now, if you talk about mutual fund company, which are those mutual funds which have increased the stake or have just entered in RBL Bank? So some of the big names are SBI Mutual Funds with 3.3% stake, Tata MF with 2.1% stake, HDFC MF with 1.6%, Aditya Birla MF 1.3%, ICICI Prudential MF with 1.2%, Mirai MF with 1.1%. These mutual funds have created fresh additions, basically have made fresh entry in the RBL Bank in the first quarter from April to June. Two mutual funds, that is Nippon Life, has increased stake to 4.3% from 3.1%, while Quant Mutual Fund maintains its stake around 6.6%. So now just look at the stock of RBL Bank. This month, it's up almost 10%, and in 2025, it has outperformed by wide margin all the other banks, and it's up almost 70%.
Okay, Sudarshan, thank you so much for the latest update coming in here for RBL Bank. But on that note, we're actually going to slip into a very short break. And, after the break, we'll bring you a conversation that we're going to be having with HDFC Live. So stay tuned in for that after this break. Welcome back to Halftime Report on CNBC-TV18. And like we promised, we do have the management of HDFC Live joining in with us to talk to us about the Q1 FY26 numbers. And we do have Vipul Patalkar, who's joining us right now on the show. When you're looking at it, HDFC Live as of now is trading with slight bit of a premium, positive sign that we're seeing coming in and an uptick that we're seeing after the numbers of the company. So, Vibha, thank you so much for joining in with us on the show. And firstly, if you could just start by talking to us about overall the numbers that are coming in for the company. What are we watching out for in terms of the APE growth, the VNB growth for FY26? What is the expectation there?
Right now, given the macro situation and given that consumption has been sluggish, we still think that growth will be a shade lower than overall for all sectors, including insurance, than what we have seen in the past year. For insurance, more specifically, first half for us grew by 31%. So we also have to contend with a base effect. If I were to even out the base effect, then if I were to look at first quarter growth, it has been a very respectable 21% on a 2-year CAGR basis.
The question is, Vibha, the FY25 APE growth, that was 18%. Will FY26 be lower than that? And if yes, how much lower?
Yeah, so we grew 18%. Of course, it was a story of two halves last year, wherein first half for us was around 31% and lower in the second half, averaging out to 18%. But if I were to look at on an overall basis at an 18% growth, which is nothing but the story that time and again over several cohorts of 4 years, and this is there in our investor presentation, on several cohorts, we have doubled every 4 to 4.5 years, which is we're saying, growth in the region of 16 to 18% is something that is the rightful place.
Okay, that's interesting, Vibha. But, when you're looking at it right now, ULIP share has remained quite flat in this quarter. Do you expect it to pick up in Q2 or second half of FY26? And do you think FY26 could be the year of product mix dominated by ULIPs? And or maybe we could see a bit of a flat margin on that front as well, or a compressed margin?
So as far as ULIPs is concerned, we have been range bound. So it is not that ULIP growth isn't there or demand is not there, and hence we ended at 38% as ULIP share. That is not the case at all. In fact, we would rein ULIPs to a handle of about 30 to 35% in terms of the outer limit. So at 38%, we are already on the upper end of the outer limit in terms of balanced product mix, which is core to the way HDFC Life does business. That's point number one. Point number two is that even in quarter 1, we have deliberately reduced our dependence on ULIP. If you look at quarter 4, ULIPs were about 43% on a standalone quarter basis versus 38% that we have managed to rein it in. Third point is that we are looking at how to make unit linked more profitable. As you know, it is for an insurer, life insurer, it is one of the least profitable products, especially at market economics. And they were looking at many ways in which we can improve the profitability to move to double-digit kind of margins on unit linked. And happy to share that we are very well on our way to increasing margins on unit linked.
All right, so higher par book, lower non-par book, and higher ULIPs. What does that do to your margins? Because, you know, the street believes that this could be margin dilutive. Where do margins come in for FY26?
So I want to, before I get to the full year margins, let us just deconstruct quarter 1 margins, because optically it looks like quarter 1 margins have been fairly range bound. Last year, quarter 1 last year was 25%, quarter 1 this year was 25.1%. But if you look a little bit deeper, and the waterfall is there in our investor presentation, you will see that the starting point itself of 25% last year would have been lower by 0.3% or 30 basis points due to surrender charges. And this came in effective from 1st of October last year. So against 24.7%, we have delivered a margin of 25.1%. So it is an increase already of 40 basis points. To your question on where are we likely to end, what we are looking at is fairly range-bound margins, optically range-bound. The way I'm saying 25 has gone up to 25%, 25.1%. So optically range-bound, but underlying, actually, there will be an increase in margin to make up for the full year impact of surrender charges. Whatever margin uplift we could get, especially in the second half of the year, if what we talked about in terms of the consumption story getting better, then we will want to invest it back into the business in 2 directions. One is in growing our own proprietary channel. So this is our agency channel as well as direct to customer channels, both in person and online, as well as we are well on our way to delivering benefits from investment in Project Inspire, which is our flagship technology transformation project. So these are the 2 aspects that we will continue to invest in while holding margins.
Okay, while holding margins, but overall then, for FY26, could margins be slightly lower than FY25? What are we watching out for?
Look, rather than being tethered to a margin, the focus in terms of priority, number 1 is to grow faster than industry, and that's something that we have time and again demonstrated over the past several years. Second is in terms of VNB growth, and we're saying that VNB growth will be in line with APE growth. And that is important, and that will be a function of both top line as well as margin, while keeping margin range bound. Now, whether it is a little bit lower or higher, I think we will look at how macroeconomics are panning out, what are customer preferences. But you will see that other than due to either a COVID or regulatory recalibration of business models, our margins have continued to hold or trend upwards.
What's the one immediate thing you would want the new IRDAI chairman to focus on, and the one thing you would want him to do differently from the previous one? Because there's a lot of chatter around this one. The industry wants something.
I think last last few years have seen a lot of support that the sector has had, whether it's expenses of management, whether it is looking at sub-debt related rules, so freeing up, our ability to raise capital, whether it's looking at some of the weights on solvency, many things that I can rattle off. I think it has been a very good innings, very supportive, and trying to think big. I think now with the new regime, it is imperative, and proof of the pudding is growth back. I think that is extremely important. The number one thing would be to facilitate how growth can come back, while of course looking at many other aspects like risk-based solvency, IFRS. These are all forward-looking aspects for the sector.
All right, we take that point. Thank you so much, Vibha, for joining in, giving us your view on the year ahead. You expect, some growth to be lower than last year, but fairly range-bound when it comes to margins as well, even though slightly lower. We'll watch out for, how growth comes by for this year, how margins are. But as we take that short break, just pull up the intraday chart of SBI. It's a big up move that we're seeing on that counter. And alongside SBI, we have Asian Paints as well. A good, move is what we've seen on the stock from the lows. It has seen a fair amount of recovery. In fact, the stock had made a low of closer to 2200, around that amount where, the JSW AkzoNobel paint deal was announced. And from there on, the Asian Paint stock has moved higher. There have been a couple of brokerage upgrades as well. Asian Paints and SBI stocks of the last 20 minutes. Take a short break. On the other side, Pritesh Mehta of Yes Securities joins in with trading ideas. Welcome back. Absolutely flat for the frontline indices, mildly lower for the frontline Nifty and Sensex, but that's largely, off lows led by some of the stocks that we earlier mentioned. SBI, one of them, Infosys. Reliance too reports its numbers towards the end of this week, has recovered a fair bit from the lows. The broader market is doing a lot better, the Nifty Bank as well. So let's pull up all the major indices for today, take a look at how FNO is playing out in today's session so far. We have the Nifty Bank, which was outperforming on Friday and Monday along with Tuesday, currently holding with gains of almost 0.25%, even as the frontline indices are flat. We have the broader markets where more number of stocks are advancing than the number of stocks that are declining, even though the lines are close to each other. The green line is above the red line. What does all of this mean for expiry tomorrow? The street believes that maybe there could be some sort of range that would be playing out. What is this range? Ahead of expiry, you have the straddle, which is a call and a put together, seeing extremely active bids in trade. So you have 25,150 call, premium of 80 rupees. 25,150 put comes up for you. That has a premium of roughly 40 rupees. So 80 plus 40, 120 rupees is the premium that you pocket if you sell that 25,150 straddle. Then you are playing for a broader range. On the way up is close to around 25,270. On the lower level, you are expecting some support coming by just around that 25,000 mark. If you want to broaden that range, then a 25,200 call, which has a premium of 55 rupees, and a 25,100 put, which has a premium of 28 rupees. Again, playing for that range between 25,050 to 25,250 itself. The 20-day moving average on the Nifty, that's the most crucial number to track on the way up if there is a recovery. Closing above that would, signal further short covering from these call writers. The other thing we are looking at are a bunch of individual stocks. So you have, stocks like Patanjali Foods and Biocon, both of them seeing high moves or up moves and fresh long build-up. Ekta told us why Biocon. And for Patanjali Foods, remember the board meets tomorrow to consider a bonus issue as well. And Angel One, that's fairly excited in today's trading session with a lot of open interest jump. The stock may enter FNO ban, so keeping an eye out on that one.
Okay, all right, Mangalam, thanks very much for that. So that's on the entire FNO space. We have Pritesh Mehta joining in from Yes Securities to tell us what he's tracking on the technicals today. Pritesh, hi, welcome to the show. Well, it is turning out to be a day where we are fairly, you would say, resilient as compared to at least what the US markets did overnight. What's your approach today?
Yeah, good afternoon. Now, see, the weakness that we saw from last week's trade, rather, I would say, cool off that we saw from the top, it has reached an exhaustion point. Even when we look at our customized breadth, it has stabilized at lower levels. So, I think breadth is yet to confirm bullish crossover. So, till the time the breadth is not participate on the upside, I think market is going to consume time at lower levels. We are not likely to see any meaningful rally from here on. But if we keep the index aside and look at the broader markets, they are outperforming. Nifty is far away from July peak, but that's not the case with mid cap index. That's not the case with small cap index. They're outperforming. So I think keep the index aside, focus on the broader markets. This is the place where we are going to make money.
Okay. And what are your top bets that you're looking at right now?
So there are a couple of ideas on the buy side. The first one is buy on Manappuram Finance. Now this stock went through a corrective phase from second week of June. Then it found support around 10 column average, and from that it has seen a reversal. It is trying to break, provide a bullish ABC break. So buy for a target of around 330. The support will be of around 250. The second one is buy on Canada Bank. Now see, this particular stock is outperforming the PSU Bank basket, PSU Bank index. It is trying to surpass the peak of April 2024 on the relative strength chart. So when I look at the standalone chart, it is providing a bullish follow through to the anchor column. So buy for a target of 145. The stop loss would be around 105.
Okay, Pritesh, thank you so much for joining with us on the show, giving us an idea in terms of what to watch out for in terms of markets as well as stocks that you're watching out for as well. We have DB Corp that's reported its numbers as well. Revenues down 5%. We're seeing ad revenues are down by 7% as well, and margins seeing a sharp contraction this time. So yes, after that, we've seen the stock see a sharp slip coming in, post the numbers down almost 3.5% in the trading session right now. But let's get you an exclusive, and this is what we're picking up from our sources who are telling CNBC-TV18 that further consolidation of PSU banks may be on the cards. Sapna is joining in with us to give us details on this front. Sapna?
Yeah, hi. So absolutely right. This is what we are picking up as of now. And this basically aligns, with the government's thinking of having large banks. I think that's the stated aim. So, merging the smaller banks together is something that the government may possibly explore down the line. Nothing isn't firmed up as such, but this could be part of broad thinking. Similarly, there are voices that given the push for credit growth and the fact that we need to achieve a certain certain financial sector goals, at least by 2047, if not earlier, then probably, an increase in the FDI cap, or rather the foreign investment cap of the banks, which has been at 20% for a very, very long time. I think that also needs a review and a relook. So possibly there could be some action on that front as well in the coming months. Last but not the least, similarly, in terms of consolidation in the banking sector, similarly in the PSU space, as far as the insurance companies are concerned, there too, some talks are on. I mean, these are discussions which have happened earlier also. So they may be coming back on the drawing table in terms of forming up a consolidation plan for your public sector insurance companies as well. A broader thinking also could be in terms of allowing some kind of corporate entry into the banking sector, but that's extremely tentative as of now. So what looks possible is further consolidation in the PSU space and possibly increasing the foreign investment cap beyond 20%.
Okay, all right, Sapna. Thanks very much for bringing us all of those details. So possibly PSU bank consolidation ahead. We need to take a short break on that note, but we'll get you a lot more on the market specific stocks once we're back. Stay tuned. Welcome back. Well, picking up a little bit of pace for the Bank Nifty, so up around 0.3% currently for the Bank Nifty. Do watch out for a couple of stocks. Nestle India is your top gainer, however, on the Nifty at this point, up around 2%. Wipro ahead of its numbers this week is up around 1.6%. And SBI is doing well as well. So State Bank of India is gaining on the news of a possible QIP, so that stock is up around 1.5%. But let's shift focus to the metals making headlines on account of tariffs and increased safe haven buying. As investors continue flocking towards silver, what remains to be seen is whether the yellow metal prices are poised for consolidation, and if not, then how soon can the yellow metal scale those levels of around 4,000? Hear out Francisco Blanch of BofA Global Research as he gives us a rationale on the metal pricing and triggers going forward.
We have been pretty bullish on gold for some time now. And earlier this year, as tensions rose and we saw gold breaking, just getting very close to $3,500 an ounce, we started advising people that it was time to diversify away from gold and look at other metals. The metals that we preferred in the precious space are silver and, of course, platinum. We don't like palladium as much. I mean, of course, it will rise in sympathy with the other metals, but we think platinum will outperform palladium throughout the next few months. And there's a number of reasons for that. But our favorite metals in the precious space right now, particularly going to the second half of the year, remain silver and platinum. And there is an industrial element to this, but also remember there's a big jewelry element too. When this thing started, when platinum started rising, platinum was trading at a third of the price of gold. And gold jewelry is down 20% year on year around the world. So even a small rotation away from gold jewelry, 1% gold jewelry rotation into platinum doubles the platinum deficit because platinum is such a small market compared to gold, same as silver. So that small trickling out effect is starting to build up other precious. So we remain constructive. We think silver will go to $40 per ounce, and we had a 1,400 target for platinum, but it keeps rising. So May will just keeps going higher.
I clearly get the sense that you're quite bullish on platinum and the other couple of precious metals. But what about gold? Has it run its course?
Well, so gold is a little more challenging, right? Because remember, one thing about gold is that it needs investor support. I told you jewelry demand is down a lot. And we need to see more investor money coming in. And the investor money can come either from the private sector or from the public sector. Public sector money is, of course, central banks. Central banks have been the ones driving the rally. If you go back to 2017, 2018, we didn't see central banks buying 1,000, 1,100, 1,200 tons of gold every year. We saw them buying 300, 400, 500 tons every year. So we've seen more than doubling, tripling in some cases, central bank gold purchases. And that continues. But in order for gold prices to rally beyond 3,500 and into 4,000, you need a lot more investor buy. And what drives investors into gold? Basically, it's uncertainty, right? It's remember, one thing about gold that's very important to realize is that it's already a very big market. I mean, this is not some obscure cryptocurrency or anything like that. And this is a market that's over $20 trillion, right? The U.S. Treasury market is $28 trillion in the hands of the public, and just about $20 trillion in the hands of the U.S. public, with the remaining being in the hands of foreigners. So gold and U.S. treasuries are really getting very close in size. And in fact, if you look at central bank reserves, gold has overtaken the euro already as a central bank asset. So we remain bullish. We have a $4,000 target over the next 12 months on gold, but we think you need to see continued shocks. And as you probably have seen with this news on tariffs, renewed, you mentioned it earlier in your show, this is what's driving the uncertainty and pushing investors to accumulate more yellow metal, in our view.
Francisco, also coming on copper then, and it has been a very, very volatile year for this one metal. All-time highs in the U.S. markets, not so much on LME and Shanghai, but the kind of disparity in prices that we're looking at, even premiums that the U.S. seems to be commanding right now, that 1st of August is not too far away. What are you reading into on what really could conspire, one? And second, what is your sense now on the prices, especially when the three exchanges really seem to be doing very, very differently in that?
Yeah, this copper has been a fascinating story. I mean, last week we saw massive movements in the copper price. We were bullish U.S. copper and advising people to be long U.S. copper because obviously that's where the pressure point was going to come. But I don't think anyone expected 50%. I mean, that was very, very high. The market ripped on the news, and as the 50% tariff became confirmed, copper kept on rallying. So U.S. copper. Of course, LME copper not so much, and so on, and Shanghai not so much. But the U.S., right, for quite a long time, we've seen copper flowing into America. We've also seen gold flowing into America, by the way. I mean, it's been a common pattern because we've seen 50% tariffs applied on aluminum and on steel. So people have been rushing to bring stuff into the U.S. Commodities have been effectively at the center of some of that front loading that I was discussing earlier. And I think with the case with copper, to me is kind of fascinating because the real issue in the copper market is that there is a shortage of copper ores. And the differential between the copper ore price and the price of refined copper, once you've processed the ore and turned it into that refined copper, is very very minimal, right? I mean, there is almost no value in refining that copper. So the tariffs are effectively going to encourage potentially more refining of copper in the U.S., but I don't see refineries being built on these tariffs.
So Francisco, what's your sense then on prices going forward, and do you see this disparity continue in case of copper?
Well, the disparity continues because the tariff is there. But I think in terms of demand, right, we told people like in the short run, prices will spike. But if you look out into the next few months, there's going to be demand destruction because suddenly if you're an industrial in the U.S., you got to pay 50% more for that copper, right? And you're becoming less competitive. That's the challenge with tariffs. If you're a producer of sophisticated aluminum cast parts, for instance, your input costs went up 50%. So you're less competitive in the global market.
Oh, absolutely.
It's the same thing. So I think ultimately we'll see demand destruction and eventually that will feed into somewhat lower prices, particularly in the LME and in China depends a little more on what the dynamics of the Chinese economy are. But I think the LME price will struggle to keep going higher. The U.S. price, of course, will remain high.
All right, so that's about the commodities action, but let's tell you something that we're very thrilled to share. The next chapter in CNBC-TV18's journey, the launch of CNBC-TV18 Prime, which is our premium subscription-based platform designed to deliver world-class insights and in-depth global coverage to India's decision makers. To mark this milestone, we're hosting a special evening of dialogue and connection with a curated gathering of leaders and change makers. With the likes of Bain & Company's Manny Makeda, Delphi Capital Management's Robert, and market veteran Ramdev Agarwal, HDFC Life's Dheeraj Relly, former Foreign Minister of Singapore George Yeo, and former Foreign Secretary Shyam Saran, along with Brookfield's Ankur Gupta, will be a part of this landmark celebration. Join us on CNBC TV 18, 5 p.m. onwards. All right, when we started the show, two of the indices were mildly in the red, two of them mildly in the green. Now, the ones that are in the green have increased their greenness, and the ones which were in the red have moved into the green. So 23 points higher for the Nifty, led higher by the banking stocks, led higher by the IT stocks, and also Tata Consumer. A couple of these consumer names doing well. So we had Nestle, which was doing well all through the day, along with Asian Paints. Now Tata Consumer too has moved to the high point of trade. But the broader markets, no problems, continue to do well. And Dixon Tech is one of them, trading in the green. A trifecta of positive news coming in for Dixon Tech.
Absolutely. So, you know, what we're watching out for in terms of the news flows. Firstly, let's talk about the main news flow that came in overnight. Acquisition of Q-Tech. Now, what is Q-Tech? Q-Tech is a camera module supplier Globally, it's among the top 5. In India, it's the largest. So this acquisition, 51% stake is what Dixon will be acquiring in Q-Tech. And obviously, this will give value addition to its backward integration that the company has been following, right? So in terms of backward integration for its smartphone business, now this is the camera module side, which is also they are acquiring this part of the business. Other than that, there's a JV that they have signed. This is with Chongqing UI, which is a precision component manufacturer. Now, this is a JV, so where Dixon will have 74% and the company will have 26%. That is, Chongqing will have 26%. This company is into mainly precision components, which are used in mobile phones, whether you look at it and also in terms of laptops, automotive devices as well, and applications. So, yes, a lot of segments of Dixon get covered here. So, these are positives that are coming in here. And do not forget that, Dixon has been focusing a lot more in terms of backward integration. The last one also came in from HKC as well, which was a JV that they had for backward integration of display modules. So smartphone backward integration is a thumbs up that is given by analysts. And today also, when they look at the brokerage notes that came in this morning, CLSA, they maintain the outperformance rating here. Target price of 19,000 rupees. They're saying that this acquisition will add value to Dixon's smartphone side of the business, where value addition was 15 to 17%. It could move up to 45 to 55%. Improvement in terms of margins by 150 to 200 basis point. Revenue stream also seeing an improvement there. And overall additional revenue will come in from this front. Even JP Morgan highlighting similarly that, this could lead to an earnings upgrade for the company, given the backward integration has been so strong. They're assuming that, this acquisition and JV and everything would be completed in Q2 FY26, and that would start yielding benefits for the company in the second half of the year. So FY26, 2% additional revenue is what one could watch out for here, as well as for FY27, revenues also could further see an increase of around 3% as well. So interesting to watch out for here, especially in terms of margins, additional revenue that we're watching out for as of now as well.
Okay, all right, Vinny, that's on Dixon Technologies. But TechM is in focus. It will be reporting its Q1 FY26 earnings today. Reema's here with details on what we can expect from TechM.
Well, expect the second consecutive quarter of a revenue drop. So on the top line, dollar revenue is likely to go up by 1%, but constant currency, that's expected to drop by nearly 0.7%. And as I said, this would be the second consecutive quarter of revenue weakness. Where Tech Mahindra has been improving has been on margins. Margins have been steadily going up now for the last 6-7 straight quarters. In fact, margins may have bottomed out in Q2 of FY24. That's about 7 quarters back, and margins were at 4.7%. And since then, they've been steadily inching up. 10.9% is our poll for Q1, but the company's aspiration is to hit 15% margins by the end of FY27. So we still have some time to go. So how does the company get to those margins? And they'd also said, as a part of Mohit Joshi, who is the CEO, as a part of his turnaround plan, he also wanted to get to industry-leading growth by the end of 3 years, which comes to an end in FY27. So, the path to that, this turnaround progress, will be tracked very closely by the street.
Right, Reema. Stay on, but L&T Tech Services also reporting its numbers. What's the street expecting here?
For LTTS, it's expected to be a muted quarter. Revenues for the company are seen down 2% on a quarter-on-quarter basis. Constant currency revenue growth is likely to fall even more, down close to about 3%. This is an account of weakness in one of the businesses, Smart World SWC. Even high-tech has been a bit subdued. Automotive has been under pressure. So the outlook for mobility has been weak too. Margins are likely to remain flattish, so 13.4% versus 13.2%. Now, here the big question is, last time the company did acknowledge that, Q4 didn't pan out as we were expecting. We thought we would grow, we didn't. But we still hold on to a double-digit revenue growth in FY26. Now, does the company maintain that? Because Q1 is going to be soft. So that is going to be the crucial part for L&T Tech. That does the company hold on to its double-digit revenue aspiration? Back to you.
Absolutely will be important to watch out for whether they hold on to that aspiration of double-digit revenue. Thank you so much for that, Reema. But on that note, we're going to slip into a very short break. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m.
Welcome back. Well, a little better for the advance decline ratio this afternoon. So around 2,200 stocks advancing to around 1,700 stocks declining. From the broader markets, just watch out for a couple of stocks. So Unichem Labs seems to be showing a lot of traction today. It's up around 8.5%. Good going for that particular counter. And Metropolis has had quite a choppy week, year you'd have to say. But Metropolis is now showing a good up move of around 6.5 to 7%. But that's what's taking place in terms of a couple of specific stocks. Consumer, IT and financials are the three big pockets to watch out for, says Samir Arora, who's the founder and fund manager at Helios Capital. He also adds that India has a strong case with favourable readings on inflation, interest rates and more. Listen in to what he had to say.
First big goof up is that not to invest in any new technology, helping others. You have to guide the world a little bit every day to only focus on what is, to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like, but they are disappointing on many levels, philosophically and on a day-to-day basis. India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency, dollar has depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months. Overall, market growth is about 13-14%, which is sort of normal. Right now, it's below normal. In financials, we expect that the growth rates will go back. That is in the banks and all. In terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no, because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap, and therefore you have to cover some other angles to spend that money or invest that money.